Mike, you're going to go through your presentation. If any of the participants have any questions, the best is to put it in the chat box and we will review them as we go so that we can get everybody's questions answered. All right.
All right. Can I share my screen?
Yes.
Okay. All right. Hey, everybody. As Jennifer said, I'm Mike DeMar. I'm a CPA in the Tampa Bay area. We handle, a little over 500 associations. We do some level of service for, and this is really all we do. In addition to that, I used to be I'm a board member on a condo and HOAs. I've been on boards, and this is a kind of a topic that is right in my wheelhouse, and that I find it, I'm pretty passionate about being a board member and what comes along with that. So I understand that a lot of you have different experiences being on boards and different experiences in being accounting. I hope that everybody's able to pick up at least a little something from this presentation. All right. Start the slideshow. Give me 1 second here. All right. So can everybody see this? You don't see it? All right, let me try to share my
Yes,
screen.
we can see your slideshow.
Oh, you can? Okay.
Yes.
All right. Okay, so by the end of the course, a couple things that hopefully you'll have a little more knowledge about. It's what is fiduciary responsibility means. We'll talk a little bit about budgeting and the budgeting process. We'll go over the reserves. We'll talk about reserves a little bit, and then the financial statements, and then different accounting methods. So we're going to try to hit on all of these topics, and I'll try to get through all of it. About 65 slides, so looking at probably about a slide a minute or so. But if anybody has any questions, as Jennifer said, you can put it in the chat, and I'll try to stop in between sections here and take questions as they come up. All right, so let's get going. All right, so the first slide here is this quote, which I think is perfect. It says, "With great power comes great responsibility." Does anybody know where that comes from? Does that sound familiar at all?
Was it Eisenhower?
He may have originally came up with it. I was going for the less historical. Uncle Ben said it to Peter Parker on Spider-Man. So Eisenhower may have also said it, though. So I find this to be it's a good quote in that being a board member gives you great power. You can really rock somebody's world, not only financially, but also this is where they live. So you can, as board members, we can do things that really could disrupt their lives. So there's the power, and with that power comes the responsibility. And by responsibility, I'm referring to the fiduciary responsibility that comes with being a board member. Now, fiduciary responsibility is the highest level of responsibility that or due care that an individual can have for an organization. And really what it says is you have the duty to act on somebody else's for the benefit of the association, and really taking yourself out of the equation when it comes to making decisions. This is a concept that I'm really passionate about. I take it very seriously. As a board member, and there's been a lot of situations where I've seen where it's really easy to think that, well, what I think for myself is probably what's best for everybody else too. So I'm going to go with that. And I think that as a board member, really important to have the mindset of just stepping back and totally taking yourself out, saying what is best for the organization. So the second part of this is you have the duty to act with good faith, diligence, care, and skill. So with that, that's basically saying, okay, now that I've got the right mindset, how do I implement it? How do I execute that responsibility? And it's with making your decisions in good faith, diligence, care, and with skill, all important aspects of that definition. So looking at this Venn diagram, you can see that you get loyalty, ordinary, and reasonable care, and then confidentiality are all these three different concepts that are all involved in this fiduciary responsibility. So the first one being the duty of loyalty, right? So it's basically saying this to act fairly in good faith, the interest, basically what I was just saying. You make decisions based on what's best for the organization or the association, not what's in your own best interest. An example is, people hear the word kickback. Obviously, that's something that's for your own best interest, and that's not for the best interest of the association. But as a board member, what if you are a business owner yourself and a vendor says, look, if you select us for this large job, we'll kick back some business your way, something like that. That can really be something that's like, well, this really is the best vendor for the association, and there's really no rules that say that I can't do business with this vendor my own after the fact, because I won't be disclosing any related party transactions. So I think I can probably make that work. And like I said, this is what's best for the association. And I'm not saying that it's not. I'm just saying that that's really kind of, a difficult balancing act. This organization that I was involved with recently, we had one of the board members came in, and she had a lot of personal relationships, and it became apparent to me and to the other board members that she was really acting in the best, in her best, in the interest of what was best for her in her own agenda. So me and the other board members, and I, we decided that she had to remove herself from being a board member, and when she did, this was really one of the biggest points that I really harped on was, and it's not something that I enjoy doing or like doing, but it became obvious that look, that you have a duty of loyalty to this organization, and from these acts, you've shown that you've really used your own personal interest ahead of the organization. So the second one is a duty of confidentiality. Now these are basically, as a board member, like I said, you have a lot of power, you have a lot of knowledge, you get to know things that other people don't get to know, and so confidentiality is a huge part of it. That while that knowledge that you gained the knowledge that we gained is as a in the realm of our being on a board. So that information, when you step out and you're no longer a board member, you cannot divulge that information because that information was only gained while being a board member. And I think that's important. So it's not confidentiality just while being a board member, but it's also being confidentiality indefinitely, infinitely, forever. And one example being, one of the things is the owners sometimes they have a payment plan, and if that's how your association works, where you allow owners to come and basically give a hardship reason why the assessments are delinquent and work out a payment plan, then that information needs to just stay as a board member. So 5 years after being a board member, if you're still in the community and you see this individual driving around in a new car and saying, wow, that's crazy, this individual was on a payment plan. I don't know how he or she can afford this car now. Obviously, that's something that's breaking that duty of confidentiality. Attorney client privileges is another great one. You know, a lot of times there are lawsuits, and usually there's settlements, and a lot of times in these settlements, board members are not allowed to disclose the details of the lawsuit. I had one of these that happened personally when I was on a board, and there was a lawsuit, and I guess the defendant we ended up settling, but this defendant had a lot of close ties to a lot of the owners, didn't want the information to get out exactly what happened. And, you know, so that needs to be respected. So obviously now, me and the other board members, we're not allowed to disclose any of that information. If we did, then that the defendant, or I guess his insurance company, might be able to get back that settlement, in which case then the association would probably come after me or whoever it was that broke that confidentiality agreement. So the last one is the duty of care. And this is something where it becomes a lot easier to have this duty of care when you're able to when we're able to bring ourselves out of the, take a step back and look at the association as a whole, and not have ourselves in it, you know, not being so invested in it emotionally, where sound judgments are not being made. So being able to take a step back and then making prudent, reasonable decisions based on, you know, what is customary, what is prudent, what a reasonable person would do under the same scenario. So when this ordinary and reasonable care is breached, well, there's a couple of ways. One is not enforcing the governing documents. There was somewhat of a famous case, and I know that a lot of times there are, you know, the 1 in a million example where this rarely ever happens. And this, what I'm about to give you, is one of them, but at least it shows a good point. And this happened in Washington, so it wasn't even in Florida, but there was a case where an owner wanted to build a one-story home, but all the other homes were 2 stories, and the board denied this homeowner's request to build this home that was only 1 story. So this homeowner went to court, and the court ended up enforcing, or at least ruling on the owner's side. And the association, it wasn't even the association, it was the board members individually had to pay this owner a combined $200,000. The reason the court held that was, now again, what made this a little bit murky was that the governing documents were not very clear on what you could and could not build in the home. And what the court found was that the board didn't even look at where the home would have been, didn't look at the other homes, didn't look at the drawings of what the home was going to look like, didn't do any of that, which the court felt was, well, this is what the court said. It said, the court ruled that even discretionary decisions by the board or the entire HOA must reflect good faith and be reasonable. That is, reflecting such care as a reasonably prudent person in like positions would use in similar circumstances. So that's what the court said. And the reason why they said that was because a reasonable person wouldn't just say, no, we're not going to allow you to build that home because it's 1 story. A reasonable person would go and they would look at the home, and they would try to visualize what that home would look like, because it was an empty lot. And they would look at the surrounding homes, and they would make the decision that way. They may have come to the same conclusion that, look, no, this is going to look, you know, it's not going to look aesthetically pleasing with the rest of the houses, so we deny your request. But they didn't even do that, and the courts felt that was reasonable. I thought it was a little strange that the homeowners were actually, or that the board was actually personally liable to pay that. But again, that was it was in Washington, maybe slightly different rules. I can't imagine that happening in Florida. I know of every HOA that I've seen, the architectural requirements are usually pretty buttoned up. So that's just one example of breaching the ordinary reasonable care. Another example is establishing a budget. You know, the documents and the Florida law requires you establish an annual budget. So that's something that's required by the board. And another thing is lacking sound business judgment. And that is really understanding the financial implications of decisions. Now, this is everybody as a board. I understand that different board members have different financial understanding. A lot of times we're relying on the treasurer to really guide the rest of the board when it comes to these decisions. So before I go further, does anybody have any questions?
We do have one in the chat for you, and it's from Ron.
I am trying to find out how to get back to the chats.
I can read it for you. It says, at an open board meeting, does identifying home addresses that are delinquent on their monthly fees a violation of confidentiality?
Good question. I don't have the answer to that. I would think that it's definitely the fact that even you're asking that question and that it's not a clear no, that it's not, means that it's probably something to look into. I would think that it is, unless, I mean, is the identifier, there probably should be some other way of identifying the homes as opposed to an address. So I would leave that up to the attorneys. I hate to go that route and say that, but you know, I think if it were me that were delinquent, I would not want that to be out there. I don't know that really that the homeowners need to know, unless there's a lien. I guess that's when you get to the point where you're putting a lien on the home, and then that becomes public record. I think that's where the HOA is definitely safe in having that information, because it is then public. But before that, it's probably safest to have some other identifier. This is my opinion. A lot of these are my opinions. That's the route that I would go, is having some other identifier. That's not very obviously, somebody's address, that anybody else at a board meeting would be able to see it. A lot of times there's the monthly packets, and that the residents get the balance sheet and the income statement, and the board is the one that gets the delinquencies and all of that. Good question though, especially since I don't have a definite answer to it. All right, anybody else?
No, someone just suggested that they use unit numbers, not names, as a possibility versus the addresses. So other than that,
Yeah,
we're good to go.
a great suggestion. Okay. All right. So next is establishing a budget, right? So both the condo statute, which is section 718 of the Florida statutes, and the HOA statute, they both have very similar language, and both of them say you have to establish an annual budget that determines your revenues, your expenses, and with your revenues, you get your assessments. The condo statute also specifies which expense categories need to be included. Those expense, administration, those are ones that probably most associations still have, but if any of these apply, they have to be included as a minimum if you're a condo. HOA is probably a good basis to use these as well. any of these slides, I will be able to, I'll send this slide out to Jennifer, and she can forward it on to whomever wants. There's a lot of information on them that just because we only have an hour, I'm not going to be able to cover everything. I'm just going to try to hit on the the most important concepts. And this is the HOA. Like I said, HOAs are set chapter 720. And it basically says the same thing, that it's a provide a budget each year, revenues and expenses, and so very similar to the condo budget. So this is just an example of what the income or the revenue side of a budget would look like. I know everybody here has seen a budget before, but I just wanted to touch on a couple of things here. So this right here, again, there's a lot of different revenue categories. You can see right here that the total income is $1,534,000. The reason why the total income is that amount is because, well, every budget that I've seen, or most of the budget, 99% of the budgets that I see that associations prepare have a zero net income. So there was $1,534,000 of expenses, which is why there's that much income. So when you look at the income, you see that the maintenance fees are only 1.3 million in this year. So when you're looking at the $1.3 million of maintenance fees, the difference there is all the other revenue items. So you think the association brings in all this money, all this revenue, that really those other revenue items are used to reduce the amount of maintenance fees that is owed by the owners. One of the other concepts to consider is a lot of times, and we'll talk a little bit about this later, but associations have excess. They've accumulated a lot of retained earnings, and you get to a point where it's just, you want to be prudent. You want to make sure you've got a decent amount of funds in your retained earnings, just in case you end up needing it because of certain repairs or whatever. But you come to a certain point where it's like, you know what, we need to start reducing these retained earnings, these excess funds that we've accumulated all these years. Well, one way of doing that would be to have the example of the same budget, but to have a separate line item here that's in revenue that basically just says prior year surplus. And let's just, for argument's sake, say it's $100,000. So you want to use $100,000 of your prior year surplus. So you would include it in the budget here. And like I said, the total income is 1.534 million, because that's what your total expenses are. So that doesn't change. The only thing that changes, because now that you've got an extra $100,000 in your income, is your maintenance fees goes down by 100,000, right? So that's how you essentially are repaying the owners from past income. A lot of times owners will say that you're required to pay me back this money. I would never recommend actually paying back the owners for previous profits. I think that this method is a lot better way of actually repaying the owners by reducing future assessments. So like I said, assessment, a couple of things to pick up there. Number one is the assessment income is the majority of the revenue. And then this brings up the second thing, which you can reduce your assessments by using prior year surpluses, by the method I just said, by having that you have a separate line item that says prior year surpluses. Now, for the budget purpose, because you want to balance out the budget, you will have the revenues need to be the same as the expenses. So you put that in as a revenue item. But if we were doing the audit, if you had a $1.3 million revenue, you probably need an audit. That is not considered revenue. So if your budget was exactly like your actual results, which wouldn't happen, but if it did, then the association would have $100,000 operating loss for the year. So you're basically starting in the hole, but that's just kind of a mechanism of how the association is trying to repay the owners. And I think that's somewhat of an easy explanation you can have to if any homeowners look at the audit and they say, oh, how I can't believe, we lost $100,000. It's explaining to them, look, we actually budgeted in $100,000 loss to try to, reduce that retained earnings. So, Jennifer, are there any questions at this point? Sorry, I don't know how to get back to that to see.
Oh, no, that's fine. No, I just want to make sure that everybody knows that we will be sharing this presentation via email. So just email your manager if you want to for the slideshow, and we will send it.
Thank you. So I will be remiss in not at least bringing up taxes when doing a presentation. So I don't want to. I could do an entire presentation, entire hour talking about taxes, and I'm not going to. But I do want to just touch on a couple of different things. Number one is that associations are the most unique industry in that there are two options, or there's one of two forms that a association can file each year. It's the 1120H, which is a specialized form for HOAs and condos. And then there's a regular 1120, which all corporations file. So any association can file an 1120 any year. But that association, only associations that qualify to file an 1120H can file an 1120H. Now, there's pros and cons to each of these. One of the biggest con to 1120H is actually there's a higher tax rate than the 1120. It's 30% versus 21% for the 1120. But with that aside, even if you do owe taxes, unless you owe a tremendous amount of taxes, then for the most part, the 1120H is most advantageous for associations. So the 1120H, but in order to file it, you have to qualify for it. And there's 3 different tests that the association has to pass. For the most part, if you're residential and if your revenue looks like the one I was showing, where the majority of your revenue is coming from assessments, then you most likely qualify for the 1120H. And if you qualify, you probably should file an 1120H. So that's ones that 60% of your income needs to be what's considered exempt function income. I'll talk about that in 1 second. So by and large, exempt function income is similar to income that actually is coming from the members. So association fees are exempt function, which an exempt meaning that you don't have to pay taxes on it. That's not taxable income. So 60% of your income has to be non-taxable income. 90% of your expenses have to be expenses that were incurred because of those exempt function income items. And for the most part, that is going to be the case. So that shouldn't be an issue. And then the third test is this substantially residential test, which again, if you're residential, it's not an issue, but that's basically saying that 85% of your, roughly 85% needs to be residential. All right. So this is kind of what I was saying before, that your exempt function is usually funds that are coming from members. There are a couple of examples where it's not the case, like laundry facility. So any laundry income, that becomes non-exempt. So you are taxed on the laundry income, but you can offset that with certain expenses, such as utility expenses. One of the biggest items is interest that is non-function. So associations are do pay taxes on interest. Again, you can offset that with certain expenses. You should definitely get with your CPA to try to offset as many expenses as possible against the interest. In the past, has not really been an issue, but this past year has obviously been a huge issue for a lot of associations, especially those that have, like $1 million in their reserves, and then they're getting 5% interest, so they have $50,000 of interest income. You can't really, I'm not really sure how to offset $50,000 of interest income. You can offset some of it, but not not 50,000. It's that would be really hard to do. So you would probably have to owe taxes, and you may not have had to pay taxes in the past. So if you fail to you fail any of the tests in this example, the 60% income test, then you must file a Form 1120 because you no longer qualify for an 1120H. And in this case, the association will be taxed on any income that doesn't come from members. So like we talked about, interest is one example. But unless the association follows the proper protocol, they may also have to pay any income that they receive actually from members. So there's a specific protocol that needs to be done. There's a vote that the membership needs to make. And again, get with your CPA. And the reason I'm bringing this up in this section is because in budgeting, when you start to budget, you should, that's when we will know, like, oh, wow, we might be bumping up against this 60% income. We may not be able to pass this test. And in which case we'll need to file 1120. We need to know what we need to do so that we don't have to pay taxes on all of our income, just the non-member income. So that's really important. Again, as a board member, just kind of identify these things and just know to speak to the CPA. The CPA should be able to walk you through the scenario. All right, so yeah, in this example here, again, this was what I showed before. If this were the actual results, then you would look at the exempt function income, which is really everything other than the rental income here. And then the water income is also non-exempt. So if you take those away, then we have 88% of all the revenue is exempt function, which is greater than the 60%. So you don't have any issues. So while you're doing your budget, this is kind of something that you would want to go through, is to look at all of those items and say, okay, just make sure that you don't anticipate that that's going to be an issue. And then obviously we talked about some of the major expenses. I think everybody knows that. So again, just moving along with the budget, what I like to do is bracket the budget into three main categories. You've got fixed expenses, semi-fixed expenses, and then your discretionary expenses. So when I'm looking at the fixed expenses, these are the expenses that you know that you're going to need and you really can't survive without. This is like the management contract, landscaping, insurance, reserves. These are things that you know are fixed. There's the semi-fixed items, which is similar in that you know you're going to need them. You don't know when you're going to need them or how much they're going to be. Examples are repairs and maintenance, legal fees would be two good examples. And then there's discretionary expenses. Now, this is everything else, special projects. And this is what we talk about if there's excess retained earnings. If there's special projects, maybe this is what the board decides, like, look, we think we want to use some of those that retained earnings towards these extra projects that we have. The association that I live in now, one of the things that's been contemplated is putting a boardwalk up. Again, that would be something, let's say that ends up costing $500,000. Well, that's something that is a special project that the board would determine if that's something they want to do, and then get the membership on board with that as well. So looking at the fixed costs, the great thing about this is that the fixed costs are the majority of your budget. There's 70 to 80% of the budget, and usually there's a small variance with what the fixed costs are budgeted and what they actually are. And I know insurance has gone way up, but I think insurance carriers, they seem to be having a little better grasp now, or a better grasp of what the anticipated insurance premiums are. But of course, depending on when your premiums are up, that could vary quite a bit. But one of the benchmark that I always try to look for is I try to get for less than 5% variance on these items. Looking at the semi-fixed costs, like I said, the repairs and maintenance and legal fees, things like that, that's going to be about 20-30% of your budget, and that'll expect about a 10 to 20% variance on those. And then finally, the discretionary is usually a really small portion of the budget, 0 to 10% of the total budget. So talking about the budget and budget prep. So we're in the end of August now. It's probably something that you should be, that we should be have started the budgeting process by this point. I'd say 6 months is probably when you want to start thinking about that. And then really after the June financials have come out, so which is probably in late July, maybe that's a good time so that now you've got 6 months of actual data for the current year that you can really go on and as your starting point. So what to do from there when you're budgeting, when you're doing your budget prep? A lot of it is it's research. It's a lot of research. You can really a lot of times use your manager as a great resource, especially having Green Acre that your manager probably has other managers who have done a lot of this work as well, and that they can really kind of rely on as well. So just kind of using that team there to assist in determining some of these amounts and what to expect for the future year. Talk to an insurance agent, like I said, talk to other vendors, just get an idea of what the upcoming costs are going to be. I'm constantly getting inundated with the questions of, hey, do you expect your fees to go up next year? How much? So those questions have already started happening. Getting out RFPs, especially if there's going to be significant projects that are happening at the beginning of 2025, start sending those out now. And then this is just another kind of throw in there, but if utilities expenses are a significant portion of your budget, maybe it's analyzing some of those utility costs, trying to see what the cost is per kilowatt hour, or looking to really analyze what those expenses have been over the last 2 or 3 years, and to try to determine as accurately as possible what you can expect for those expenses. One of the things that took me a little while before I really picked up on the importance of it was taking the notes and making assumptions and having that in the budget. That became really helpful once I did it, and really took ownership of actually taking the notes and making assumptions, and then seeing how those assumptions played out the following year, at least knowing what those notes were the following year as my starting point. So what I would do is have the current, so in this case, it would be the January through June financials for 2024. I'd extrapolate out the cost for the rest of the year, and then look to see what my notes were. How close was I? Where did I go wrong? And then analyzing those variances with candor. Now, and I put with candor, I find that that's really important. And it's okay to be off. I was off a lot. I will continue to make a lot of mistakes in these budgets. But it's not just rationalizing like, oh, that's because of this happened this year, and like nothing like that's going to happen next year. But it's really trying to say, okay, is this something that's a repeatable event that we can expect to happen year over year? And if so, then we need to budget in these events that seem to be one-offs, but if one-offs happen every year, they're no longer one-offs. So it's kind of having that mindset and being candid with yourself, and really just with the goal of just every year making the budget process better and better. That doesn't mean that you're closer and closer to budget each year. It just means that you're just have more information that you're using in order to create the budget. So we don't need to really go, well, we are going to talk about reserves. I think everybody here knows what reserves are. But we will talk about what kind of items we do need to reserve for. So the reserves, obviously, anything that is going to need to be replaced in the future, and that you are going to spend more than a year trying to accumulate the funds in order to replace those reserves. Now, it's very different living in a condo and living in an HOA, and what reserves and how you need to budget for reserves. The condos are very specific. They say, okay, for every condo, the roof, you got to reserve for the roof. You got to reserve for the painting. You got to reserve for the pavement. And then you got to reserve for everything else that's $10,000. And that's straight from the statute. So that needs to be done. Now, on top of that, if your condo is 3 stories or more, you need to have a milestone inspection, and then you need to have a special reserve study. You need to have a structural integrity reserve study. So you're actually going to have 2 groups of reserve items, general reserves, and then the SIRS, or the structural integrity reserve study reserves. And the statute really specifies exactly what's considered to be structural integrity, or reserve items that are in the structural integrity area. HOAs are not as specific, and they've actually clarified recently what the HOAs need to reserve for. There's a difference between a statutory reserve and a voluntary reserve. I think in the past they've all just been kind of grouped into all being like treated like statutory reserves, but really only statutory reserves are only reserves that the developer initially established in the documents as being like, yes, these are items that you have to reserve for. A lot of times, because townhomes are within the HOA statute, you'll see like the roofs for townhomes would be in there, or painting or something like that, those would be statutory reserves. But a lot of times, all the reserves that HOA has are voluntary reserves. So while they're reserved for, those funds can really be used for any purpose. They can be used for operations as well. And again, that's a board decision if they want to do that. The example I gave earlier about building the boardwalk in our HOA, if we were to do that, then that would be something where we would probably want the membership to vote. And this is what this is the other way to get a statutory reserve, is for the membership to vote to make something a statutory reserve. So we would probably want to make that a statutory reserve where, yeah, that needs to be funded every year to replace or to make major repairs to this boardwalk, so that you don't just build it and then you never fund it and you never repair it, and then it just becomes useless. So that's an example of where an association would actually do a vote, make a vote to make a reserve item statutory. Otherwise, it'd be just voluntary. And then now getting into the reserves, again, I don't want to get into all the nitpicky details. I think the major thing to know is that there are different ways to fund the reserves. There's the component method, which you're funding each line item, each component. And then there's a pooling method where you're not funding each component necessarily. You're just funding the pool of reserves. You're just making sure that they are adequately funded. And the calculation is completely different depending on which way, which method is used. And the board can choose which method it wants to use. So the component method is where, like I said, each component is reserved for separately. So, but those funds that are used for these reserves can only be used for that reserve component. Whereas the pooling method is, like I said, one large pool. So you're just funding, there's a whole calculation that's done so that the only thing that's necessary is based on the calculation. There's never going to be a negative fund balance or a negative balance in those reserve items. So you're adequately funding the reserve, so you'll always have money to pay for the next replacement. This is an example of the component method. And again, I don't want to go through all of these, but just to show how this calculation works. And this is a calculation that comes straight from the statute. But just looking at this roof replacement, this would be something that says, okay, so this roof is supposed to last 12 years. There's only 1 year left on the roof, and the estimated cost is $95,000. As of the end of the year, there's been $87,000 that's been accumulated in this line item. And so since there's only 1 year left on the roof, in the following, so next year we have to fund $8,000. So once we fund that $8,000, then we'll have the 95,000. We'll have enough money to replace the roof. That's the concept behind it. If there were 2 years left, then, and these two numbers were the same, we would only need to fund $4,000 next year, and then we'd have to fund 4,000 the following year. So you get the idea. So you have to do this for every line item. And as you can see, if we were to do this, then the reserves are 36,312 would be in this hypothetical situation, how much the funding would be. Now, looking at the pooling method, again, a completely different calculation. You're still looking at each component, but you're just saying, okay, like in this case, in year one, we're going to have to fund 95,000. And then it's 12 years, we don't have to fund anything, but in year 13, we have to fund another 95,000, right? Because it's a 12-year useful life. So you do this exercise for all the different components. And then you say, okay, you say, okay, you know what the future outflows are. And then you would look to see what the, how much you would need to fund each year, so that just doing this calculation, you would never have a negative fund balance. As you can see, you go all the way out to year 14, you have a $4 balance. So this is the absolute minimum that you would have to fund in order to meet that the statute, the requirement. And as you can see, this is the exact same scenario as the previous example, the exact same. The only difference is the method that was used. You can see that in this case, there was 34,600, and in the other method, there was 36,312. It's like voodoo math. You have to charge, you don't have to charge less. Well, you'll find that in every situation. The pooling method, you will never have to pay as much as pay into the reserves as much as the component method. And it's just the function of how the calculation of the pooling method. So I like to throw this in here. This is a example of what this guy John. It's a little bit dated. It was over 10 years ago, but I still love it. And this is what this person said, talking about the pooling method. They said that the DBPR is a joke, and that the pooling method underpays reserves. He goes on and on. Says they do this by using a flawed and fraudulent reserve worksheet. He's talking about the DBPR. He goes on to say, you know, you will always have larger prohibited ballooning in later years, and with disastrous future consequences. And then he says that this can then cover long-term expenditures that are due. This is a formula for fiscal disaster. I think this guy went a little bit overboard here with his how much he hates the pooling method, even though the statute does allow it. The DBPR says it's fine, but he brings up a good point. If you're not funding, then you know it's not considered fully funding if you're using the pooling method. It's definitely the component method is the most conservative approach. I wouldn't go as far as what this guy John is what he's saying, but I think his point should be taken. You know, I think you should at least understand where he's coming from. And we talk about a balloon payment. There's some language in here. There's been a little bit of discrepancy as what a balloon payment is. When you're doing the pooling reserve, you can't have a balloon payment. So to me, a balloon payment is you have a certain amount and then boom, it's this much more. So it's like you're saying 20,000 a year, and then the year that we get to replace the roof, we're going to increase it to 200,000. To me, that's a balloon payment. There's other interpretations of what a balloon payment is, but basically the DBPR has come out and they've said that you don't necessarily have to have a level reserves each year, but you can't just determine what your reserves are each year. It can't just swing up and down depending on what your expenditures are that year. Like there needs to be some sort of systematic rationale for how you're doing your reserves. So if you don't just do the same amount each year, then there needs to be some sort of system for how you've determined how much you're going to reserve this year, if it's not going to be the same as next year or the year after. All right. Are there any questions? I think I have about a little less than 10 minutes left.
Yes, we have two questions in the chat.
All right.
It says, can interest earned on reserve funds be used in the budget to reduce dues?
Yes. Interest, yes, great question. Interest can be used to reduce dues, and it should be used to reduce dues. What I would say is not to take your, like in the example I gave, you have $1 million in your reserves, and you know that you're going to be getting 5% on all of it. So you really can, or you anticipate you're going to have $50,000 of interest income. I wouldn't put 50,000 in there. I would reduce it by a reasonable amount because you're going to have to pay taxes on some of it. So the most conservative approach would be to take just 70% because it's a 30% tax rate. So you would have in that example, you have $35,000 of interest income to reduce assessments.
Okay, the other question was referring to how is this different from fully funding, threshold funding, or baseline funding?
Yeah, another really good question. And those are all just different ways to fund. So baseline funding, I think, is what the example I gave where you ended up with like $4, where you just need to not go below zero. Threshold funding is something, it's like a buffer that's put in there by the association. So you don't want to go below a certain threshold, whether that's $100,000 or whether that's a percentage of something. But that's something a board would need to make. But I think as long as you don't go below zero, then as far as the statute is concerned, then you are safe. All right.
Hang on,
Okay.
we've got one more that just came in. Hang on, nope, it just said thank you. You're good.
All right. So I don't have a whole lot of time left, and I kind of left the boringest stuff for last. Not that the other stuff was necessarily riveting, but I do want to talk about, these are the association financials. Do want to touch on it. So with the association financials, just talk about how the budget first relates to the income statement, right? So this is a budget, and then this would be an example of an income statement that you would have. And as you can see here, the budgeted numbers, like the operating expenses from your budget, in this case, they equal your assessment revenue on your income statement. So that's what you look at it, is the assessments that come from operating expenses. That would be considered your assessment revenue. And then another item just to look at is, even though your reserve expenses for the year were 300,000 in this example, if you only expended 210,000, because again, your reserve expenses that you budgeted, that's based on the pooling method or the component method. That's not necessarily what you're going to expend this upcoming year. So if that was 300,000, and then in this hypothetical example, you only expend 210,000, then on your financial statements, what you would see is $210,000 of revenue. The idea being that you only record revenue for your reserves to the extent of the expenses. That's how the revenue recognition works. Again, I could do a whole course on that, but I just wanted to show that right there. The three main reports that make up the financial statements: the balance sheet, which everybody knows; the income statement, which for associations is called the statement of revenues, expenses, changes in fund balance. It's the income statement. This is the report that obviously I think that a lot of board members and a lot of associations really use during the board meetings, is the income statement to compare budget to actual. And then the statement of cash flows. And this is something really, it's only in the financial reports, and it's what the Financial Accounting Standards Board feels that these are the three main reports that really give you a good idea of what's going on with the association. And as you can see, they're all interconnected, right? So they're all allowing you to look at the association in a different way. The first one is the balance sheet. And this is a snapshot of where you are at any given point in time. The income statement Again, this is the one that's used a lot internally, and it really shows the performance of the activities over a period of time. And then the cash flows is the main thing here is it breaks the analysis down into operating, investing, and financing activities. It really gives you an idea of where the money is coming from. So there's a big difference even if you increase your cash by $100,000, there's a difference as if that came from operating activities or if it came from, investing. So if you just didn't, if the operating fund just didn't pay the reserves for the year. So it looks like the operating cash went way up, but as you can see, it's really from a financing activity because the operating fund now owes the reserves. So that's just one other thing. So you want to see that the cash is actually being gained from the operating activities. And now, again, looking at the association financials, there's just different ways to account for financials. I know I'm running out of time here. So the way that you'll see in the audits, and I'm pretty sure it's the way that Greenacre does it, which in my opinion is the best way, is the accrual method of accounting, the full accrual. It gives you the best information. A lot of associations, a lot of board members like just seeing the cash basis accounting, which gives you the least amount of information. Then there's like a modified cash accounting, which you really record the revenue the way it's supposed to be, but then the expenses you do on a cash basis. And a lot of times, that's good, but that still gives you misleading information. And when you have the incomplete information right there on the bottom, it leads to misleading, or when you have incomplete information, it leads to misleading information, which can lead to incorrect interpretations, which can then lead to poor financial decisions, which then could potentially lead to a potential breach of fiduciary duty. So I know that's maybe a little bit drastic, and to connect those dots is a little bit difficult, but really the idea is as a board member, you really want to have the best information to be able to make the best decisions. And really with the accrual accounting, which again, Greenacre uses, it's what you'll see in all your audit reports. That's the method that's going to give you the best information. So I know I kind of rushed there at the end. And again, these slides will be available to anybody who wants them, but I think we got about another minute. If anybody has any other questions.
We'll give somebody time to type.
Let me pull this down.
We've got some thank yous, excellent presentation. Again, we will have the slides available. So if you'd like to email your manager, we will make sure that they get passed along. Again, let's see. No other questions? So Mike, we appreciate your time. This is really helpful, especially in the budget season.
Yeah, absolutely. Thank you. Thank you for having me. And if anybody has any questions, again, relating to the to taxes or anything accounting wise, feel free to reach out to your CPA, or you can reach out to your manager and get my information. I'll be happy to discuss. It's kind of what I like doing is just talking about these certain things. So I'm happy to do it.
Perfect. Thank you. And everybody, thank you for attending, and have a good evening.
All right. Thanks, everybody.